The Hedge Swordsman here. It's October the 20th, 2022. I'll talk about a bunch of stuff in this video, which again, given where we are in the cycle, I think it's increasingly important. Because there's no time where mistakes get costlier than extreme highs and extreme lows. And in my opinion, mistakes are much costlier at lows than highs, for I would say pretty obvious reasons. But let's dig into it. First of all, this is a post on Reddit I've showed before, which I kind of think is funny. Someone mentions a quote by Charlie Munger. Charlie Munger is, of course, the partner to Warren Buffett, and Warren Buffett is, one of the richest men alive, and he has compounded his net worth by 26% for the last 69 years or so, and now he has like $58 billion, and a lot of people. I've seen some people that know both Warren Buffett and Charlie Munger would say that Charlie Munger is even, smarter than Warren Buffett. Anyway, Charlie Munger said, if you can't stomach 50% declines in your investment, you will get the mediocre returns you deserve. The fun is, same as with this poster, if you look out there, what do people tend to do? People tend to like to call out people, calling people bag holders, etc. There's a big stigma to having big paper losses. And that, I think, is one reason that I have an edge on the market, because I'm not afraid to have big paper losses. Typically, I sit on 50% paper losses every other year or so. I accept that. I'm not ashamed of that at all, because I know what my long-term results are. So if I need to sit on 50% paper losses or more every other 2 years in exchange for very good long-term results, that is worth it to me. But most people cannot stomach a 50% decline because they can't see it as anything else than having made a big mistake. So this post real comments, this makes absolutely no sense. First of all, that's pretty hilarious. You have the one guy who's the best in the world in a field, pretty much, saying one thing, and then this, anonymous Reddit user has the audacity and, arrogance to say that doesn't make sense. Alarm bells should be going off. He should have the self-reflection to understand that, he's missing something, obviously. That's like critiquing Michael Jordan on, how to play basketball, even if you can't, play basketball yourself. Obviously, you are missing something. And this guy doesn't have the self-reflection to understand that. So he goes on to say, if you're in the market this year and you're, let's say, fucking Peloton, some other stock, you shouldn't be stomaching it and holding it just because. On that point, he's right. What I assume he's saying here is that Peloton, etc., those are high flyers, extremely overvalued companies, etc. And that's right. You shouldn't. You shouldn't buy something that is extremely overvalued, that should go down 50% or more and not go up. You should actually be picking smart investments in one of the best bull markets I've ever seen. Again, what this tells me is he doesn't think a good investment, a good long-term investment, that shouldn't be able to go down 50%. Which is, again, absurd. Because there's no shortage of great companies that go down 50% or more now and then. And that's even for, somewhat stable businesses. You have the Amazons and Googles and all of that is, up 10,000% or whatever in the last 10 years. they go down 50%. I mean, even Berkshire Hathaway, which is one of the most diversified conglomerates on earth, can go down 50% now and then. So that's simply just not true. Because if what he's saying, if you can't stomach a 50% retracement, because he's basically saying, you should sell out if you see 50% declines, because you made a mistake in that case. You would never get those kind of returns. You would never be along the ride for these, extreme compounders. If the market itself is poor for the year, that makes sense, of course, but this idea is ridiculous. What is he talking about? I mean, he's missing the point that is pretty much what Charlie Munger means. That stuff will happen, like a bear market or whatever, where even really good companies, which have very bright futures, they go down 50%. And that's obviously where, the big opportunities are. When valuable companies go down 50% in price, that's a great opportunity. And this is a tweet from my guy I saw on Twitter yesterday, which I think was really good. All these guys complaining on a daily basis because of manipulation this and minus that. Do due diligence and arm yourself with courage. That's the best you can do in life. Don't complain about yourself like a victim every day when you meet hardship. Be a man and shut the F up. I mean, that's probably better investment advice than you could get from a corporate finance course, I would say. I mean, he nails it pretty much. He really nails it. Due diligence and courage. Typically, when you really understand a case, you've done your due diligence. That gets translated into conviction, which by outsiders would look like courage. But I mean, how courageous is it to buy something that is almost selling at cash, for example, and the business is intact? That's not really courage, even though that will look like courage. And in especially, I guess, in a cyclical sector like the miners, you need that. I would more call it hope or belief that that no sector goes down forever and no sector goes up forever. So to consider that fact that markets will be forever cyclical, maybe not courage, but like common sense and hope, for lack of a better word. Very important. Don't complain about yourself. I mean, that's when I know people. If I see someone complaining about the markets, I mean, sure, I probably complain about some stuff, etc. But it's a big tell that a person doesn't have what it takes, because obviously most people will lose in the markets, and they will be consider themselves victims of the markets, etc. But if you understand how markets work, you should be able to figure out how to beat it. So in that case, you're just a dispassionate observer and letting the opportunities come to you, because the markets will do what the markets will always do, meaning they will crash sometimes and then they will go higher and then they will crash and go higher. Excuse me. If you just understand that, it's much harder to consider yourself a victim, because it's the Mr. Market that's showing its belly, opening up opportunities for you to take advantage of. So in that sense, Mr. Market becomes a victim of you, or everybody else becomes a victim of you. So if you consider yourself a victim, you'll become a victim because you think everything is unfair and you don't have the discipline, etc., to figure out how to beat it. So you will become a victim to the other people who actually take advantage of people that consider themselves victims. And just did a funny meme, I would say. Never complains, figures out how to brutally murder the market over time, complains all the time, buy high, sell slow, and thinks life is unfair. I mean, this is 95% of people who try to do stock picking. And in the mining sector, I would say if 5% beat the, let's say broader markets, excuse me, I think like 1% might beat miners or make it in the mining sector. Even though I think the mining sector is actually, if you really look at it, is much easier to beat than the broader markets. Or at least, when you beat it, you'll have higher returns, in my opinion. Typically higher returns. This is a post I made. First, you better be able to figure out how to take advantage of sectors this volatile. Mr. Market going from batshit greedy to batshit fearful and back again. This is Tech Resources, a big base metal miner. I mean, you can see the extreme volatility here. I mean, look at these crashes. I mean, this is on the point of like, if you can't stomach a 50% retracement. If you bought here, which is obviously low, then it went down 50%. So let's say you sold out there because there's, again, no way you're not making a mistake if you're down 50%. But let's say you hold out because you understand that that's still a very cheap level. Then it goes down 50% more. So you're down, 50% and then 50%, that's minus 75% starting if you started buying here. Still, this buy would have returned, 500% in a base metal miner within 2-3 years. 500% in 2-3 years. If you didn't do anything in the market after that, it would take perhaps a decade or two for people to catch up with you, just to be along for one of these crashes to rips. Same here, 50% down, then 50% down again. Made a lot of money if you bought all the way down. If you stomached a 75% decline and just kept on buying, and this is 50% down again. It's like, you shouldn't be in this sector if you can stomach at least 50% declines. You should be able to stomach 70% declines, really. Hopefully it will not get to that point, but a lot of people, it's like, how do you lose a lot of money? I mean, most people, this, they buy here or here or here. And then they write it down, and they're down like, 90%. That's very unfortunate if you start off by that, but there's only one cure to all your past, let's say, mistakes or performance, is to make better decisions in the future. Nothing solves buying high better than increasingly buying low. Just buying, if it started to become cheap here, just buy all the way down. If you started investing here, buy. Again, if you went all in here, but then just, added 5% here, that's a good start. And if you just keep adding more and more, the cheaper something gets, you're still gonna beat the market, even if you started off the worst way possible and you're down like 95% or something. Excuse me. So buying low is the best offense and defense you could ever get. And again, if you get stomach retracements, you'll never be aboard for play like Great Bear. For example, 41% down here, 48, 46, 29, 60. 35 over 2 years. A hodler would have made a lot of money in this stock. someone who was both a hodler and bought every crash would have made even more money. I don't think traders made much, and that's like, I'm gonna get to that point later, because all the time I see it's like let the trend be your friend, etc. We're gonna look at that again, and this is Bear Creek Mining, which again is my junior sentiment proxy. I mean, if just looking at this chart or looking at this chart, it should be readily apparent, obvious how you beat the market in a volatile sector. Which goes back to my point. Requirements. Grasp the game of Pong, meaning, it bounces up and down. Have infinite patience and try to stay away from the worst companies. I would literally say that that's like all that's required. I mean, Jesus, where am I? This is the junior sector, the mining sector is like Pong. It crashes and rips, crashes, rips, crashes, rips. And you don't even need to be, again, you don't even need market timing. And if you started buying here and just bought all the way down, you made out like a bandit. If you started buying here and bought all the way down, you would be in profit. If you started buying here and bought all the way down, you would be in profit. If you started here buying all the way down, you would be in profit. If you started buying here but bought all the way down, you're probably going to be in profit. So it's like when you really think about it, it gets increasingly hard to justify not beating this sector over time. But if you also looked at, we're talking, I think, minimum for a 4-year time horizon here. If you can't be in this sector for 4 years, that's typically, let's say, what's this, 2010? This is actually 2016. So that's 6 years from top to top or crash to crash. So it's like, let's say 4 to 6 years. If you can have patience to be in this sector for that long, you're probably gonna beat the market, or you should, I think. Same goes with more alpha plays. They also ping pong. It's just that typically when they have a growth trajectory, when they have a rapid value creation pace, it's simply instead of going ponging sideways like a optionality play or a trading sardine, they tend to ping pong like this. But they can also have this is a lower low than this, for example. So it's not always going to be a straight line, but it should be obvious that this, why was this the best buy? Because the story was intact and excuse me, price was the lowest. And like I've said all the time, it's like the longer a downtrend persists and the lower it goes, the better the buy. And in the case, for example, of Great Bear, if the story is intact and they be creating value throughout all this time, the later and lower the buy, the better. This buy here is better than this, because it was getting increasingly, twice as close to the next upturn than this, assuming this is mostly sentiment driven, for example. So it's like, if you can buy lower and later, that's the buys just get better and better by definition, since no trend lasts forever. So this is tech again, and it's like, I see this all the time. I see it on Twitter, etc., etc. Almost nobody can beat this sector because it's too volatile. But everybody thinks they can. That's what I find so fascinating. If, let's say, 1% can beat the sector, 100% of people, let's say 1 out of 100 people can beat this sector over the long term. 100 people out of 100 people have opinions of what you should do. Freely give you, let's say, advice, without even beating the sector, really. That is what I find fascinating, because I constantly get, I've explained this in like 30 videos or something, and should be pretty obvious by now that we're playing Pong. We're playing Pong. Best thing you can do is load up as much as you can during one of these crashes. Because you're going to make so much money when the sector turns, and it always turns. But everybody says, let the trend be your friend. I mean, again, I think that's one of those. I mean, typically that's traders who do that, and of course, it's like if you're a trader, you're probably not going to agree with me at all, and that's totally okay, because nothing makes more sense to me than just increasingly buying the cheaper this sector gets, and I'm very happy with my long-term results so far. So it's like, why fix something that isn't broken? And it's like, if you're gonna be trading, it's like some people, well, you want to catch the bottom, let's say you want to scalp that, you want to make sure how on earth you can be 100% sure that a bottom is in, that let's say you catch this movement here. I mean, sure, that could work, but how on earth do you know when an uptrend is intact? I mean, why did it turn down here? Higher high, higher lows. So I mean, the trend is your friend here. But this time it went down. And next time we reached this spot, it didn't turn down, it went higher. So I mean, my point, I guess, is that I think it's extremely hard to know when the let's say market is going to turn, or when the trend is your friend. I mean, for example here, most people will probably not buy this because they expected it to go lower, because everybody always expects that, I mean, at this point in time, the trend is 100% not your friend. Because the trend has been down. I mean, that's the most obvious trend you see in this chart. So nobody probably buying this, for example, while it's probably absolutely dirt cheap. It reached a low of $2.46 or something a few years later, up to $31. So that's, over 1,000% return. So like, if you wait, let's say, to buy when the trend is your friend, instead of just increasingly buying when it's very cheap. I mean, this move here, I don't know when you would say the trend is your friend. It's like, I guess that depends on, depends on the trader. But I mean, let's say you do a few trend lines, for example, here. Okay, let's say you say that, okay, now it actually, the trend is my friend. It's like, yeah, sure. But if one would have piled in before, just knowing that this is gonna turn anyway, you'd already be up, like, I don't know, let's say 200% when the trend is your friend guys gets in. But the trend is your friend guys, they'll probably just buy this as well, because I mean, this looks like a break as well, because again, in hindsight it's very easy to see, well, it went lower, but I mean, this didn't go lower. This stopped here. It didn't reach this level. I mean, it might not look like much, but this is 246 and this is like 5. So that's a 50% extra retracement that people were fearing. And it's like, what do you do up here? Well, I mean, this higher high, trend is your friend. I guess what I'm saying is, like, I have no idea when something is going to change, whatever. And what I think is even more important, let's say you are just a typical trader. I mean, what's your conviction going to be? What do you do here? This was a lower low, then it went higher. I mean, what do you do now? I have no idea. All I know is that, like, when these crash and get to absurdly low valuations, I mean, if you pile in at these lows, why would you pile in? Because the trend is not your friend, etc. Because you're gonna make so much money that when you have a decision like this, you're probably gonna be up from the bottom at least for 460%. So I mean, all I know is that this sector always goes from high to low, high to low, high to low. And when it's extremely low, if you pile in at that point, or increasingly pile in, good things happen. That's just how it is. I don't know how I should trade this. I mean, there's like, false breakdowns. I mean, this is a lower low, and then it rips. I don't know how many percent, but so this is a double. I mean, how easy is it gonna be to watch this just go up 100% without getting FOMO or whatever? Now, what typically happens for me is that my portfolio crashes 50 to 60% every 2 years, then goes up, 3, 4, 500%. And it's like you don't even need to have. Again, it's like if you're not totally decimated, if you're not down. I mean, just looking at Bear Creek, for example. If you're down 90% right now in your portfolio, yeah, I think you have a problem. That can get fixed over time if you just keep on getting better at investing and again starts buying lows, because the only way you're down 90% right now, if you went all in a bunch of stocks, let's say optionality plays, at the absolute peak. Otherwise, you shouldn't be down 90% right now. And it's like for myself, I have a bunch of stocks that are down a lot. Some are down 90%. Typically, those aren't the largest positions. I mean, it's, let's say, you have 30% of your stocks down like 70% or something, just from the last high. But you have some larger positions or medium-sized positions that are down just 40%. And you have some positions that you let ride because they're good stories, and they're up a few 100%. Take this, I mean, Snowline in Western Alaska, for example. They have offset the declines in, 20 juniors or more. I mean, then you have like, Goliath, which has traded sideways. SK is, that's down from the highs, I guess like 60%, but they're not down 90%. Typically, they're not down 90%. Some of my biggest positions are up. So they're alone offsetting. So I mean, if I, for example, now, if you're not down, if you're not down 90% and switch to, let's say, cashed up optionality plays or whatever. I mean, if this just does a mean reversion, let's say, I mean, this is probably gonna go up, 600%. So if you're, or let's say 500%. So if you're down 50%. Some are, some stocks you own are down 90%, some stocks you own are down 50%, some are actually up, 100, 200% since this point in time. I mean, obviously, if you're down 50%, then it goes up 500%. You're from this point in time to that point in time, you would have made a lot of money, obviously. It's not really harder than that. I mean, we're not in the business of perfection. I'm not a market timer. I just know that all these crashes will end someday. And the longer it takes, the lower and longer it takes, the closer we get to the turn. And the lower I buy, the more I'm going to make on those buys. So it doesn't matter if I started buying up here. That doesn't take away the fact that just piling in, the cheaper it gets, the more money those buys are going to do. So maybe, $1,000 buy down here it's going to pay for a $5,000 buy up here, for example. That's just how it is. Again, buying low is your best defense and offense. And buying high doesn't change the fact that buying low is the best and selling low is the most costliest thing you can do. And again, it's like the past is the past. I've lost a lot of money in Novo, for example. I made a lot of money in Snowline in Western Alaska. all we can do is try to make the best decisions we can. We'll make money on some stories that are good stories. We're gonna lose money on some stories that are good stories. We're gonna make money in bad stories. I mean, you can never really tell. You can only make assumptions or judgment about the merits of an investment. I mean, a great case might be a great case, but it might also be high risk. It wasn't a bad case just because it went south, for example. I didn't know that Snowline was going to rip or have the results they did. But like I explained, it was simply a great case. But I don't know if I think again, I think it was a really good case, but I can't just look at Snowline going up and say, yep, that was a good decision to buy. And like Western Alaska, that I thought was a good case. I didn't know they were going to hit 100 meters, for example, and the stock would get lit on fire. That was just something that's very fortunate. And it's like in Novo, for example, I don't really regret anything other than when I went all in going into Comet Well as the results, because that was way too greedy. That was a mistake. That was greed. That was my mistake, being way too greedy. And since then I've never been all in a stock, and I don't regret that at all. I mean, I learned that lesson the hard way, and in hindsight I can know that. But other than that, it's like the case made sense back then. That okay, when it became obvious that you couldn't drill the conglomerates because the fine gold was limited to the halo of the nuggets. There is no possible way I could have known that the nuggets themselves acted as like cathodes or something and made the gold, fall out of the seawater or whatever just around them. Because I think that's a first ever example of that. I think so, at least. So I think the result is unfortunate, but there was no way I could know that. Because if those conglomerates would have been drillable and fine gold, and you could prove it up like with Watersrand, for example, I would have made a lot of money instead. But that's the past. Forget about what your portfolio has been through. Forget about if you started buying here and you're down, immensely right now. That shouldn't affect your decisions at all, because we're not investing backwards. And just to give an example, it's like if you hold out for some of these turns, worst bear market bottom, I started buying in around here, I think, and I thought I was early, or I thought I bought cheap, which I did. It's just that cheap got cheaper, but I just kept buying. So when that bottom came, my portfolio went up 500. My entire portfolio went up 500, almost 18% over the next like 8 months. So this to this 518%. And since I had been increasingly buying, my portfolio at the time of the bottom, I owned more shares than I started off with, if you know what I mean. So I made even more money than I would have if I just sucked it up. No, yes, I started buying here, but I bought all the way down. So my average might have been down here, let's say. And then the inevitable happened. Choof, turned up, and then I remember 2020 crash. Juniors went down like 50-60% in 2 months. What happened after that? One of my best rallies so far. Went on a 893% streak. Again, you need to be. That's why harp on the fact that unless you're down like 80% in your entire portfolio, I don't think it's going to be a problem within the next X years. And if you are down 80%, let's say, that doesn't change the fact that sure, you might let's say you'll not make that back if we go to if we go into 2011 levels of hype, you're gonna 80% down is nothing. I mean, Great Barrier went up 3,000% from the bottom here. But let's just assume we at least get back to some, a level like this, and portfolio goes up 400% or whatever. Yeah, you'll be back to even then. So I mean, yeah, that's not great. You're only back to even over a period of like, let's say it takes 2 more years. So you're have neutral returns over a 4-year period. That's not great, obviously. But don't forget that the overall stock market averages 8% per year. So if the next 4 years or whatever, you just become a better investor, in the next 4 years you might be up 600%. All of a sudden, that 800% period you would have beaten the market. That's what I keep saying. Forget about the past. Forget about all of that, because that doesn't matter. You can't change that anyway. You can just start making better and better decisions. It doesn't matter if you're go broke or whatever. It's like you can just start again. The thing is obviously not to become broke in the first place. And this is another point about some will be winners, some will be losers, yada yada. This is a family portfolio I manage. I think this date starts at September 2022, 15th September 2022, I think. That's up just 11% since that time. It is actually not 3 years, but it's, I hit the max, but it starts at, September 2020. Okay, September 2020, it's up 11%. That doesn't sound like much, obviously. This year it's down 31%. This is another family portfolio I manage. Same time period, 15th September 2020. That's up 26.63. That's only down 2.55% this year. Again, 26 doesn't look too good. The big difference between these, minus 31, minus 2.55, is the fact that this portfolio was able to buy Snowline. So one story that was so good that I piled in heavy into that in this portfolio, which I couldn't even buy in this one, materially changed the year-to-year results. So just, think about that. This is a bit more conservative. You can see, this went up to 80%. So that's why, the end results over this period is not too different. I'm a bit more aggressive. I'm a bit more aggressive in this one, but again, I couldn't buy Snowline, which I think is like probably the best case, one of the best cases in years. But I recognize that Snowline, after Quinton explained it on his presentations, X amount of times, and one regret I have is that I didn't buy heavier into Snowline earlier when it was already kind of obvious. But it's like, yes, perfection doesn't really matter. But think about what the GDX J did over the same time period. You see minus 2.55, minus 31. And of course, that doesn't look that great. But GDXJ is down 51.62% over the same time period. So, that handedly beats the GDXJ. And as we know, juniors tend to crash way harder on average than the GDXJ. So, again, it's like just losing less than most people during these crashes sets you up for a great future, and that's why, thankfully, so far I have not had my portfolio go down more than I think 56% in going into one of these crashes, and of course that's from the highs. Typically, the lows, the 150% correction typically is still at a higher level than the other 50% correction, because I don't invest in trading sardines typically. So it might not look like much, like, okay, you're down minus 31%. Yeah, but if you're let's say you're just minus 31%, or even 50%, or 60%, or 70%, I think, at these points in time, you're gonna get bailed out anyway, because the rips are so violent in this sector. 100% is a piece of cake. And it's just looking at some more optionality plays. I might not call them optionality plays, but it's like, again, since we know this market goes from crash to rip to crash to rip. Integra Resources, 63 million market cap, 27 million cash, not going broke anytime soon. So the question is, how risky is Integra? If people look at the price decline, people will say, oh, well, it's very risky. But how risky is it? I wouldn't say it is that risky. And if we go back to the highs again, that's several hundreds of percent. Wallbridge Mining, another market darling. What I find kind of fascinating is, like, I know some people that bashed Novo and the performance of Novo and highlighted the performance of Wallbridge. Well, Wallbridge went down almost 91%. That's why I try to not. I don't. Let's say, try to point out other people's mistakes or first of all, you don't even know if it's a mistake. We only see the share price. Was it dumb to own Wallbridge? It's like, I have no idea. Was the case good or bad? I have no idea. We can just see what the share price has done. But it's like, there's a bunch of companies. Did the value of Integra go down 89%? Did the value of Wallbridge go down 91%? I don't think so. But price did. But the market is, again, it's goes from greed to fear. They're overvalued at these tops. They're very undervalued at these lows. It just comes with the territory. Nighthawk Gold, down 93% from the highs here. 33 million cash, 33 million market cap, 27 million cash. Some recent insider buying. I think this had a market cap of around, I'm not 100% sure, like 300, maybe enterprise value was around, I don't know, at least, let's say 250 million. Enterprise value is down to 6 million. So let's say the market value the project had at 250 and now at 6 million. Does that sound plausible that the project changed that much? I think they have like 3 million ounces or close to that on the books. Is that worth $6 million? I don't think so. Again, if let's say you shuffled into some cashed up advanced explorers, like Integra, Wallbridge, Nighthawk, for example, and you're down 50%. In the case of Nighthawk, you would get back to even if the price doubled, and that's to this level. If it would go back to this other high, the last high, that would be 1,300%. So again, how big of a problem is a 50% decline in your portfolio? In my experience, not a big problem. Then I just threw in some of these. COMEX silver inventories registered category. You can see the sharp decline here. So it's like, how is this gonna end? I don't know, but this is obviously the quickest drain, the most violent drain on COMEX registered category. that can't continue forever. I mean, that's the at this rate right now, I think it has averaged like minus almost 1 million ounces. That's like 30 business days, and that would be completely empty. And obviously, if I don't think that will happen, but it's like it suggests that paper price of silver is too low. The real price of silver is higher than the paper price, so this is getting drained. That's my my assumption here. And again, it's like the past is the past. We're investing is about forever front running what's gonna happen in the future. We're front running sentiment and stuff. This is a slide I saw on Twitter. Someone was at a LBMA conference. You can see the flows to India. I mean, silver flows really big here. Obviously highest in 22. So there again appears to be a very high appetite for silver, which jives with this. But that is not reflected in the the futures trading of silver yet, at least. This, I think, just another great example of how violent some, let's say growth stocks can be. This is K92, and one could say it might be akin to Line 1, for example, which recently raised money and the share price crashed. If you just look at this, for example, it's like, yeah, okay, financing dilution went into a bottom here, then okay, 6. Okay, so that's not far off. That's just a half a year. But anyway, went into production, and you see what happened to a great growth story like this. And also would like to point out, excuse me, the value of alpha going into market crashes. So here we have, let's overlay Bear Creek Mining, which is a trading sardine. So you can see here what happens to a company that is creating a lot of value. What can happen to the share price? When Bear Creek topped, and most mature plays and junior grassroots exploration plays, yada yada, when they've gone down like 80-90%, K92 was doing good work, having great success, etc., etc. So that just went sideways. And it's like when I look at Snowline, for example, today, people are complaining that Snowline isn't going up more. I mean, I think Snowline is worth, or probably worth around $10 right now, but it's trading at $2.76, something like that. But that's the thing, that it's not that there's not a, I mean, if they tried sideways, you should really not be complaining, because that is a sentiment discount. Let's say K92 should probably, I mean, let's say this is the actual value to price gap right now, because they have been creating value. So as sentiment got worse and worse, the price to value, the value to price gap kept increasing. But since value was going up, that just, made the price go sideways. Whereas Bear Creek Mining, which hasn't really created much in terms of extra value and might have a fair value here, this is the value to price gap, or maybe it's actually more down here or something. So it typically this might be as cheap as Bear Creek Mining. Well, I don't really know if I should say that Bear Creek Mining is cheap because I don't know that well. I mean, I think it's cheap, even though I don't think that's a great story. But my point is that even though it might look like K92 is expensive relative to Bear Creek Mining, that might not simply be the case. But this is what typically what happens. And I mean, again, if you're down, I mean, this has gone sideways. I mean, just think about it. Let's say, where is it? Let's say you have, again, it's like you have K92, etc. Let's say you were only in K92 and you have gone sideways during this period. And let's say you could change up your portfolio at any time. Maybe you start, maybe you go into Nighthawk Gold, maybe you go into Wallbridge Mining, maybe you go into Integra, whatever. I mean, just some of these cashed up, more trading sardine type companies that are more trading sardines right now, at least. Again, I would guess that the average, these plays will go up to the next sentiment high. It's like 300%. So if you're neutral over this period, then up 300% in the next 2 years. I mean, imagine how great returns those are. So again, at surface, it might not look like much that price has gone sideways, because again, I see people complain about Snowline that it's not going higher. Well, that's true. I mean, I think it should be valued a lot higher, but there's nothing really. I mean, that's just how this sector works. It is under appreciating value by an extreme amount typically right now. But if you just have, let's say, a few that has not totally crashed, and especially, I mean, the main point is that the case is intact. I mean, there's a bunch of stuff that's down 90% that probably should be down 90% because they don't have anything of value, etc. But those are completely different things. Eloro, another example. I mean, that's again, I think a great point. I mean, it feels sucky because like Eloro has just kept on hitting. Last news release just a few days ago, they extended the strike of their higher grade feeder zone by 400 meters. Stock didn't do much. I mean, 400 meters. I don't know what kind of value that, implied value that packed on. Let's say $100 million. I think the whole market cap of the company is like 250. So let's just say that implied value went up by, or at least 50 million or 100 million, whatever. Let's say, by quite a bit relative to market cap. That's one news release. So whereas the value of Eloro, as they have had real success upon real success, it has just kept on going higher and higher. The system is growing and it's getting de-risked. Yet price peaked back in early 2021. But that's again the point of like, there is a huge sentiment discount in Eloro. It's just that it has created so much value that instead of crashing like a great Bear Creek Mining, which had let's say a stagnant value curve, it has just gone sideways. But I mean, if you had a decent position in Eloro throughout this time, I mean, let's say your average is around here. I mean, yeah, you might be down like, I don't know, 20%. You're certainly not down 80%. So again, at face value, it might not look like much. But if you have a few of these really good stories, I mean, because what typically, I mean, what would I expect to happen? My guess is that this is going to break to the upside one day, and that should probably at least be like a $2 move. I mean, this is so long that it's probably gonna break higher than that if I had to guess, but let's say because this height is like $2. So let's say you are 2 years of no returns, and then all of a sudden, sentiment returns, this breaks higher or whatever, and you're up, double to start with. So let's say that takes 3 years. That's still very good returns. And I don't think, again, I mean, the actual value of Eloro is probably, I mean, way higher. I mean, I think the net present value of what they have is going to be worth, when the economic study is out, etc. I think it's, easily over $1 billion. I think, I mean, maybe 2 billions. and it's trading at 250 million right now. And I mean, you can see, I mean, again, here you have like a stagnant price over, let's say, a year. All of a sudden, poof, revalued, went up 250%. But that's where infinite patience comes in, because we don't know when this will bottom and turn around. We just know that it will. And that's good enough. I mean, just betting on that. Mean reversion, inevitable mean reversion. You can't help but beat this sector. I mean, I personally think mining sector is easy. In theory, it is probably one of the easiest sectors to beat because it's so volatile. In practice, 1 in 100 might beat it because it is so volatile. So the same reason why it's easy is the same reason why it's hard. But if you understand that you dispassionately look like this, yes, people are crazy right now. People are crazy right now. One day they're not going to be crazy, or crazy to the opposite side. You're going to make a lot of money. If you have the patience to wait for all that to happen. Yeah, I think I'm going to cut it here, actually, and then continue in another video. Thanks for listening. I hope you got something out of that. Don't treat this as investing advice. If I talked about any companies, assume I'm biased, assume I'm sponsored, assume I own them. I don't own Bear Creek Mining. But again, always do your own due diligence, because the most important thing is not what I think or do. The most important thing is what you think and do. If you don't have conviction, you can borrow my conviction. That's why I continue to do these videos, because I want to highlight and hammer in some points that hopefully you'll start to understand, see, and believe them as well. And then you don't need me anymore. Thanks for listening. Hit the thumbs up if you like this video. Bye.